There's a meaningful reason to have your joint investment account be an individual investment account. Could be thousands of dollars in tax savings, but is it for you? I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, you want to save thousands of dollars when it comes to transitioning accounts? Yes, you obviously do. Therefore, here's my question. Should you have your joint investment account stay as a joint account, or should you move it to an individual account, potentially save thousands of dollars? I'm going to explain that coming up, but first let me tell you, I'm not talking about retirement accounts, and really that should be the number one decision that you're making when you start deciding, working with your CFP, which accounts and how much should I be saving for retirement. You've got to figure out what's your tax shelter strategy, okay? What's your tax shelter strategy? Yes, I'm going to figure out how much I should be saving for retirement, but where do I put it? Does it make sense to put it in the 401k, the Roth 401k, the IRA, the Roth IRA, what, right? So those dollars, great, those are tax sheltered accounts, fantastic. What I'm talking about is if there's any reason to have additional dollars saved up in a non-IRA, non-tax sheltered account, so non-401k, non-IRA account, okay? Then you have a decision, do you own that investment account? Do you hold it individual, where it's just in your name? Or if you're married or maybe have a close family member, something like that, do you hold it joint? Big question. By default, I would argue you should have it joint. Hold that thing joint, and I'll explain the reasons coming up. But there's an enormous reason, thousands of dollars attached to it, why you may want to hold it individual instead. What's that reason? Step up in cost basis at your death. Think about this. Okay, so I'm already saying we're not talking about your Roth IRA, 401k, that sort of stuff. All that's tax sheltered. For these non-tax sheltered, non-IRA investment accounts, if you bought Apple stock way down here and you've held it your entire life, and then when you pass away, its value is up here. If you own that individually, then your heirs, your beneficiary, receives that account, and they do not have to pay tax on the difference between where you bought it and where it was as of the date you died. That's called a step up in cost basis. Before you die, if you say, you know what, I need this cash, I'm going to sell my Apple stock, you're going to have to pay tax on all that. You're going to have to pay a capital gain on all that. It's going to be reported on your tax return. But if your beneficiaries, if your heirs inherit that account up here, okay, then they get a step up in cost basis and avoid paying tax on all of that amount. So that's if they inherit it. What if you own it jointly? What if you and your spouse own it? And again, same thing, you bought Apple stock, or you bought the S&P 500 index, or you bought an investment way down here, you held it for a long time or whatever, and it's worth this in a joint account, and then you pass away. Your spouse is a joint owner. Half of that account is technically theirs, and they did not die. You passed away, so half of the account gets a step up in cost basis, but the other half doesn't. Meaning, again, sophisticated, using my hand as an example, if you bought it down here and it's worth this, when your spouse passes away, your cost basis moves up halfway, moves up to this. You will still, if you sell that investment, you will still have to pay capital gains tax on the remaining portion. You get a half step up in cost basis if you own that account jointly. You see what I mean? This could be thousands of dollars in potential tax savings if you structure this appropriately. Now, does that mean everyone in every situation should own all of these non-retirement account, tax sheltered account, it should be held individually instead of joint? No way. It only makes sense in certain situations. I would only do this if you're married and one of you has a very likely a shorter life expectancy than the other. Maybe you've got a health diagnosis that, oh gosh, hopefully everything's good right now, but my health is not as good as as my spouse's, and therefore we're going to hold this account individually in my name, just in case, just due to the likelihood that I'll pass away early, they'll get a step up in cost basis. So I would do it when when you're married and one of you has a shorter life expectancy than the other. Otherwise, if you're just gambling, oh no, we both have similar life expectancy, you may not get any step up in cost basis, right? Because you might happen to own it individually and the other person is the one that passes away first. I'd rather have partial or half step up in basis than none at all, okay? And that leads me to the second circumstance when I would consider this. I wouldn't consider it at any age. I wouldn't consider this while you're young or while you're still working. I would own it jointly. I would for obvious reasons I'll share in just a second. It's just when you get later in life, and I'm not talking about, by the time you retire, it changes. No, late 70s, maybe even into your 80s, where it becomes clearer that one of you, your health is a little bit different. If it's still not at that time, you guys are both still healthy, fantastic, I probably would still keep it joint, but work with your CFP. It's very circumstantial. I just would not apply this to every circumstance without giving some careful consideration. Because when an account is held joint, it's just easier to administer. It's just easier to administer. If one person's out of the country or unavailable, the other person has legal rights and can request a change or request dollars out of it, can access the account. It's just easier to administer when it's held joint, and you just don't know. We have no idea, even if you've got a terrible health diagnosis, the other individual could pass away first. When my father-in-law was going through Alzheimer's, the amount of strain that it put on his primary caretaker, my mother-in-law, it was just awful. And she went through her own couple health issues during that time where, oh my goodness, my wife and I would talk, oh, could you imagine if something happened to her before him, right? We've all thought, so you just never know. So a joint account makes sense until it becomes clear that one individual's life expectancy is shorter than the others. And then I can't stress this enough. If you're doing this, or gosh, even while you have the joint account, but certainly when you transition and say, yeah, you know what, let's have this be an individual account instead, maybe we can get this step up in cost basis, make sure, I can't stress this enough, you add a transfer on death, a TOD, adding that beneficiary to the account. Doesn't cost anything. It's just an extra step. You go and open up that individual account with your financial advisor or online. You got to go do the extra step of adding a transfer on death, a TOD designation, which adds beneficiaries to the account. Why is that important? So that when they pass away, the account goes directly to that other person. Avoiding probate, avoiding all sorts of cost and complexity, avoiding a lot of a lengthy process. It can go directly to them. Okay, no cost, no probate, no issue, all right? That's adding a TOD, a transfer on death, adding the beneficiary to the account, especially if you've held the account jointly, you and your spouse, and all of a sudden you say, you know what, makes sense for the one with the shorter life expectancy to be the owner. You're gonna wanna make sure that you add the TOD so that the primary beneficiary is the other spouse. The one with the longer life expectancy, so they receive those dollars with no probate and no complication at all. Tricky strategy. I hope this creativity expanded your thinking on your own situation. Does it make sense for you? You can only know in the full process, the full comprehensive financial planning process that you go through with your CFP. So work with them on that. If you don't have a certified financial planner that's helping you with comprehensive financial planning, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.